Hello, hi. Welcome to the online classes organized by the School of Distance Education, University of Calicut. In this session, we are going to discuss about the core paper in the fourth semester BBA, Financial Management. Before going to the discussion, we have to analyze the area or the syllabus of the topic. You have to follow 5 modules under your syllabus. It is the first module includes scope and objectives of the financial management, investment or capital investment decision, then financial decision, dividend decision, and working capital management. These are the major areas in your paper. Then first module. In this session we are discussing about the first module only. First module includes the financial management, its meaning, nature and scope of finance, financial goals of the organization, profit maximization or wealth maximization, then finance functions, next investment decision, financing and dividend decisions. All these things will be covered in different chapters detailedly. So the financial management like all other management or functional areas of management, it is the managerial activity which is concerned with the planning and control of firm's financial resources. So like marketing and HR, here we are planning, controlling, organizing, or doing all the managerial functions related to the financial activities, financial resources of the organization. In other words, it is concerned with the acquiring, financing and managing assets to accomplish the overall goal of the organization or business enterprise. So these are the key words: acquiring, financing and managing assets to accomplish the overall goal of the organization. The overall goal of the organization is the profit maximization and wealth maximization of the shareholders. So you can see the definitions. So in your paper, in your examination, there will be some questions relating to the define or what is financial management. So you can follow any definitions. Soloman, Ezra and John Pringle have given a definition relating to the financial management. It is the concern with the efficient use of important economic resources, namely capital funds. And also J.L. Massey have given another definition. So there are 3 key elements in the process of financial management. Financial manager has to go through 3 elements. The first element is financial planning. Just like the planning, we have to plan which are the sources of fund, where we have to invest, how will be the dividend should be distributed or not. These are all the things related to the financial acquiring of fund and its utilization and its return, etc. should be planned in well. So management needs to ensure enough funding is available at the right time to meet the needs of the business. So otherwise the business can't operate. So we have short term and long term needs of the fund, and also in the case of short term needs, the company has working capital requirements. The case of long term need, permanent assets should be financed through this fund. So all this should be planned in proper way. So that is one of the key element, financial planning. Second is financial control over the financial inflow and outflow of the fund. Financial control address the questions like assets being used effectively or not, then are the business assets are secure, then do management act in the best interest of shareholders. The best interest of shareholders means shareholders have invested their fund in the organization, and if we are able to give adequate rate of return on their investment, then only they can have an interest in the organization. So management has to consider these questions while financial plans. This is the second point: financial control and financial planning. And third key element is the decision relating to the finance. Key aspects of financial decision making relate to the investment decision, financing decision and dividend distribution decision. So these are the major key elements in financial management. So financial planning, financial control and financial decision making. Next, what are the nature of financial management? Like other management activity, what are the nature of financial management? You can summarize like these points. It is an indispensable organ of the business. Without financial management, business can't run, because finance is the lifeblood of the organization. It is a function, its function is different from accounting function. Accounting is just recording, classifying, summarizing, but financial management is the major decision relating to the investment and dividend and financing decision of the organization. It has long term impact, so proper guidance and proper control should be there in the case of finance management. It is centralized function of the organization. Then it is helpful in decision of top management. So financial decision, major strategic financial decisions are taken by the top management. Then it is applicable to all types of concerns, whether it is small scale industry, large scale industry, or medium scale industry. Anywhere it is applicable. It needs financial planning, control, and follow. Proper follow up, planning, and controlling is necessary in the case of financial management. Then it is related with the different disciplines like economics, accounting, law, information technology, mathematics, etc. All these subjects are related to the financial management. Mathematical formulas are used for the financial forecasting. Accounting is also used. Economic theories are used in financial management. So these are a major nature of the features of financial management. Then scope and functions of financial management. Scope means the area where it covers, and function means functional areas. So what are financial managers doing in their business? So financial managers are estimating the total requirement of funds. First is estimation of total, that means planning, estimation of total requirements of funds for the organization. Raising of fund is the another thing. Raising fund from various sources, long term and short term sources are available, so with less cost. That is a key point. Then investing fund in both long term as well as short term. Investing, raising fund, estimation of fund requirement. Then funding day to day working capital requirements of the organization. Another is collecting on time from debtors. Debtors have other person, they have to give, they have out to money to the organization, so timely collection of the fund is necessary. Then managing fund and treasury operations of the operations, ensuring satisfactory return to all stakeholders. In the case of stakeholders means the shareholders, employees, related parties, business associates, then financial team, everybody should be satisfied if we have adequate return on investment, adequate timely payment to the creditors, timely payment to the financial institutions, timely payment of wage and salary to the employees. So these are the stakeholders, those interested parties. Interested parties are stakeholders, so they should be satisfied if we are paying in time. So financial management is necessary for that. Paying interest to borrowers, repaying lenders due date. So these are the stakeholders of the organization. Then only we can create a goodwill and good relation with this team. Then maximizing wealth of the shareholders over long term. If shareholders wealth is maximized, the business can invest more and more projects. Then that will create employment opportunities, that will create better atmosphere in the organization. So that is necessary. Interfacing with capital investment. More some points are also to be discussed. Awareness to all the latest development in the financial market. So financial management must have awareness about the recent financial policies of the government, financial market changes, conditions of the short term and long term market, like capital market and money market instruments, etc. So increasing the firm's competitive financial strength through the proper management. Without the proper and efficient management, we can't increase firm's financial capacity. That will lose the credibility of the organization. Then adhering to the requirements of corporate governance. So these are the major things. The major functions of financial management can be illustrated in these words: investment decision, financing decision, and dividend. Already we had told that in which project we have to be invested. Then from where we have to finance or raise fund, whether equity, preference share, or debentures are issued or taken loans from the financial institution or etc. So dividend decision means decision relating to whether to or not distribute the dividend of the organization or whether to retain the profit etc. Then functional areas can be broadly explained once again like this: capital budgeting decisions. Capital budgeting decision will be discussed in our next class, next video lecturing. Working capital management is another chapter in your topic. Then dividend policies also relating to the dividend distribution or not. Then acquisition and mergers, corporate taxation of the organization, determining the financial needs, determining the source of fund, long term and short term sources had to be discussed. Then analysis of the financial statement, financial condition of the organization, future needs and future financial state conditions of the organization. Then optimal capital structure should be formed. Cost to volume profit analysis should be conducted. Cost to volume profit, profitability in relation to cost and the sales of the organization should be analyzed. So profit planning and control of the organization. Then fixed asset management, then project planning and evaluation and implementation, in which project we have to be implemented or invested or fund. These are the major things where functional areas broadly can be classified. Then objectives of financial management, a lot of things have to be discussed here. The major objectives are profit maximization. Profit maximization means maximizing the profit through the sales volume. If we are maximizing the profit, the wealth of the shareholders should be also maximized. Okay, so if the wealth of the organization's shareholders are maximized, shareholders will be satisfied and they will give better atmosphere in the organization, better business condition will be there, better business expansion and diversification may be happen, they can create more employment opportunities in the society etc. So these two terms are interrelated and this is the major most important objective of the organization: profit maximization and wealth maximization. Okay, then achieve higher growth rate in the market, attaining a large market share in the sense in the customer base. Then promoting employee welfare. If we have enough profit, we can promote employees welfare. We can achieve if we are achieve high growth rate, employees should be paid well, and we can give welfare and fringe benefits to these employees, so they will be satisfied, productivity may increase, that will enhance the business once again. So increasing customer satisfaction by providing better good quality product in reasonable prices. So the major objectives are these. Then improving community life by providing welfare of the community, contributing something to the welfare of the society. So these are the major things you had to go through in your first chapter, module 1. It is just a general outline. In the later classes we will discuss what are the capital investment decisions, dividend decisions, working capital etc. So thank you all. Thank you. Hi, welcome to the online classes arranged by School of Distance Education, Calicut University. In this session we are discussing the second module of our topic of financial management. The discussion is relating to the capital budgeting. In the second module, the syllabus covers terms related to the capital budgeting and the major techniques related to the capital budgeting. Techniques or methods we will discuss here. So before that we had to discuss what's the meaning of capital budgeting. Capital budgeting or capital investment decision relating to the decision about the capital expenditure. That is the decision to invest the current funds of business concern most effectively in fixed assets and project in anticipation of the expected flow of future benefit over series of years. That simply it is the decision about whether to invest in a project or not is the decision relating to the capital investment decision or capital budgeting. Okay. So let's see the another meaning. It is the process of identifying, analyzing and selecting investment project. Identifying, analyzing and selecting of investment projects whose return, that is the cash inflows, are expected to extend beyond 1 year. So it is a long term investment plan. In this plan we have to analyze the whether it will be the profitable or not. So once this decision is taken and investment is started, it cannot be changed because it is long term. So what are the features of capital budgeting? So in this case the investment will be huge amount will be invested in the long term business. So the investment decision should be taken care. High degree of risk is associated with this investment, and it affects future competitive strength of the organization. The decision is difficult. So here how to take the decision is important. So we have a lot of methods or formed by different experts. So and another feature is estimation of large profit. So while determining taking decision related to the investment, we had to estimate large profit, whether the company is or the project is able to give the profit, adequate profit the business or not. So long term effect of the company and the existence of the business should be analyzed. Then it affects the cost structure of the organization. Cost structure means the mix of equity, preference and debentures, etc. So the decision once taken cannot be reversed, so it is irreversible in nature. So these are the major features of capital budgeting. So the decision process, capital budgeting decision process include, first of all we have to identify the investment proposal. Best investment proposal or a group of investment proposals should be identified. Then we have to analyze or screen the proposals. All the proposals should be screened, that means whether it is profitable or not. Then evaluation of these proposals. Screening and evaluation means we will evaluate the profitability and the risk associated with the project. Then we will fix priorities as per the policies and or objectives of the organization. After that, final approval and preparation of the capital expenditure budget. We will prepare, or finally we will select some of the projects, then we will prepare capital expenditure budget for the future plan, and we will implement the proposal. So and its performance review is the last step. So a capital budgeting process is a complex, it is a decision making is a complex process. So it should take care while taking such decisions. We have to analyze the methods. Which are the methods of capital budgeting or evaluation of investment proposal? That means investment appraisal techniques. So there will be a essay question you can expect from this area. We have a lot of methods. It can be classified as traditional methods and modern methods. The traditional method, the major traditional method include payback period method or pay out or pay off method. So payback method is the first one. This is simple to calculate. The major thing is it didn't consider the future present value of the future inflow is the major criticism. Second is average rate of return or accounting rate of return. These are the major traditional methods, ARR and payback period. These two are simple to calculate. Then time adjusted method or discounted method. Traditional means traditional, then time adjusted or modern method. That means time adjusted or discount. That means discounted means the values should be converted into the present values. Future inflow, future profit, future inflow or return on investment will be converted to the present value. Then we will compare the project's profitability and things. So we will select based on this. So this is more suitable to the organization because it considers the present value of future inflow, future cash flow. So which are the methods? Let's see. It is the net present values, very important thing, net NPV, then profitability index and internal rate of return, IRR. Another one is net terminal value method. So these are the major terms or methods of capital budgeting decision. You may expect an essay question from this area, or some of the especially NPV or IRR there will be some paragraph questions also. Problems may be come here from this area. let's see which are the technique or details to these methods. Payback method. Payback method is the length of the time necessary to recoup the initial investment from net cash flows. So here we will analyze the length of time and how many time it will raise. Suppose if you are investing 1 lakh rupees and how many years it take to recoup. That is a method under this. So the payback period can be calculated in two different situations, as when annual cash flows are equal or when the annual cash flows are unequal. In the case of when annual cash flows are equal, payback period can be calculated as original cost of the project with the net annual net cash inflow. So original cost, if it is 1 lakh and the annual cash flows, that means you have 8 years of the project and every year it returns to the 20,000 rupees. So you will divide 1 lakh divided by 20,000. So you will get an answer. So that will be the payback period, 2 year, 3 year, etc. So in the case of when cash flows are unequal, we will calculate the payback period from the cumulative cash flows when it will be it will take to be equal. So this is the simplest method, and under this method the decision is when the shorter the payback period, better will be the shorter the payback period. Here the payback period better will be the, so that means in the case of two projects, one take 2 years to recoup the initial investment, and in the case of project B, suppose it take 3 years. So our investment will be recouped within 2 years. That means better will be the shorter period. We will select project A instead of B. B take 3 years suppose. So this is the method under payback period. This is easy to calculate. Second is accounting rate of return or average rate of return. Under this method, we will the ARR is the ratio of average after tax profit to average book investment. So you can calculate this by using the formula average income or average return divided by average investment into 100. So average investment means original investment plus scrap value by 2. Original investment plus scrap value divided by 2. This is the average investment. Then we can calculate the average income. So average income divided by average income investment into 100 is the method. This is also simple to calculate. There is no mathematical complexities under these two methods, under the average ARR and payback method. So here the higher the rate of ARR, higher the rate of return means the better project. So suppose project A gives 25% and B gives 30%, means project B will be better because it has higher average rate of return. Next, in the case of time adjusted method, this is the net present value. Net present value is of the project cash flow minus total cost of the project. So here what we will do is we will calculate the net present value of the cash inflow, NPV of the cash inflow, and out of this we will minus the cost of the project. Suppose we have 2 lakh as a project cost and the net present value of the future inflow, we will calculate, estimate them, then we will deduct that. Suppose future, it is a time adjusted method, so we have to convert the factors with the present values. The value should be, suppose it is 3 lakh. So 3 lakh minus 2 lakh, 1 lakh will be the profit. So this kind of method here we uses time adjusted method is the thing. So it also simple, but you have to convert the present value of the future cash inflows based on the table values. So if NPV is positive, it means the actual rate of return is more. That means your total cash inflow is 3 lakh and total your investment is 2 lakh. That means 1 lakh is the profit, or 1 lakh is positive. 1 lakh is positive figure. That suppose you have invested 2 lakh and your investment return is 1.8 lakh. That means it is 2 lakh and your return is 2.5 lakh. That means minus 50,000 is the answer. So NPV is negative. That means you are investing 2 lakh. You are investing 2 lakh, but 2.5 lakh, but you are actually getting 2 lakh. So 50,000 is negative. So you can't accept under this condition. So if NPV is positive, it means the actual rate of return is more than the discount rate. So the decision rule in here is invest the positive NPV project or reject the negative things. So how to compute NPV? This is the most probable area to ask your paragraph or essay question. So you have to work out the problems here. Determination of the minimum rate of return. So that is your expected 10%, 20%. Then you have to compute the present value of cash inflows and outflows. Present value of outflow, that means your actual investment, but inflow should be converted to the present value. How to convert means cash flow into discount factor for the concerned period. You can take this value from the present value table. Then compute NP means present value of cash inflow minus actual investment. So you will get a positive or negative value. If it is positive, you will accept, otherwise you will reject. Another is internal rate of return. This is a concept method explained by Joel Dean. It is also called time adjusted rate of return. Time adjusted rate of return. So IRR is the rate of return. Here the rate of return at which the total present value of the future cash flow is equal to the initial investment. So that means NPV will be the 0. So the discount rate that equates the project NPV to 0 is the IRR. And the decision rule in relating to IRR, internal rate of return, means if the calculated IRR is compared with the NPV or the desired minimum rate of return, if it is equal to or greater than the minimum rate of return, if we have expected 20% and we got that 20% or 15% equal to or more than the 20%, we will accept it, otherwise will be rejected. This is the decision rule in IRR. Then second last one is profitability index. Profitability index also called benefit cost ratio. So this is also called benefit cost ratio. Under this, it is equal to the present value of future cash flows divided by the initial cash investment. Present value of future cash flows divided by the initial cash investment. So it can be calculated by using the formula profitability index. This is an index. So discounted cash inflow. Cash inflow means our return, and discounted cash outflow. So you will get an index, a rate. So suitable where the project having different investment. This is in the case of IRR and other, while comparing other things, if the project had different investment outlay, you can use this profitability index method. So here, as long as the profitability index exceeds more than 1, the project should be accepted. That means if you are getting 0.75 as your profitability index, that means only 75% of the your investment is covering. So it should be more than 1%. More than 1% means you are getting profit. And last term is net terminal value method or NTV method. This is also simple. It is a discounted time adjusted method, but here you have two assumptions. In the case of net terminal value method, each cash flow is reinvested in another project. So if we are using reinvesting in another project at a predetermined rate of return, and we are using this technique in two conditions. Each cash inflows is reinvested elsewhere immediately after the completion of the another project. So a continuation will be there. So in this kind, we will take the decisions relating to the, if the present value of sum total of the computed reinvestment cash flow is greater than present value of the outflow. That means inflow is greater than outflow, the project under consideration will be accepted, otherwise will be rejected. So these are the major methods you have to focus So you have to expect an essay question or some problems will be from this area. And another technical term relating to the capital budgeting is capital rationing. Capital rationing, it is a situation where the company has a lot of projects, but the company cannot invest their in all projects. We have company has two or more profitable projects, but they cannot invest in all projects. So this is a condition, a situation. So it occurs when the company chooses not to fund all positive NPV projects. Positive NPV project means if we are considering 5 projects, out of these 4 projects are positive, we can select 4 projects, but we have enough fund to invest. So this situation is called capital rationing. The company typically sets an upper limit here on the total amount of capital expenditure. That means in this year we will invest 1 crore only. So but actually our project need 1.2 crore or 2 crore etc. But our upper limit is exceeding. So that situation is called capital rationing. Under this situation, what the company can do is company will make preference to the out of four projects they will make preference. So third project will be implemented first. Suppose then second project will be implemented secondly. Then first. Then this kind of ranking may be given. After that they will invest in the project. So these are the major things come under this capital rationing and capital budgeting decision. I think you have clear. Thank you for watching. Thank you all. Hi friends, welcome to the online classes organized by School of Distance Education, Calicut University. In this session, we are discussing the third module of financial management, your core paper. The topic is related to the working capital. In this module, your syllabus covers relating to the working capital, its type and financing of working capital, sources of working capital, then management of inventory, management of cash, management of accounts receivable. These are the major area we have to discuss here. So working capital means firms holding of current or short-term assets such as receivables, inventory, marketable securities, etc. These items are also referred to circulating capital, working capital or circulating capital. So the concept of working capital, you have two possible interpretations relating to the concept of working capital. That is the balance sheet concept or operating cycle concept. In the balance sheet concept, we can say that two type of things you have to discuss here. That is the net working capital or the gross working capital. Net working capital means the excess of current asset over current liabilities. So net working capital means current asset minus current liabilities. Then the gross concept of working capital means total current asset. Amount invested in total current asset is called gross working capital. And the second concept is operating cycle concept. Operating cycle, as the name indicates, it is the average time elapses between the purchase of raw material to the final cash realization. You can explain this based on this flow. So the working capital cycle or operating cycle can be illustrated as, so we have cash. By using this cash we'll purchase raw materials. So the raw material will be converted, that means you have account payable, that is creditors. So this raw material will be converted to the work in progress. Then it will value added, then it will be next move to the finished goods. The finished goods will be sold. So sales arises. If the sales is arising, what will happen is we have some credit debtors, that is account receivables or bills receivables. So this account receivable should be converted into cash. So this process take a lot of time. So if it is shortened, the working capital requirement will be low. So the concept of operating cycle is the flow from cash to raw material to work in progress to finished goods, then the finished goods will be sold, then we will get account receivable or debtors. These debtors should be realized into cash, then we will continue this process. So the this period of converting the cash into raw material to the finished goods sales to again cash is called the concept of operating cycle or working capital cycle. So before going to the discussion, we have to keep in mind which are the items in the discussion of working capital. Working capital means the investment in current asset, especially and current liability. So current asset means cash and bank balances. Temporary investments, that means short term loans, short term investments. Receivables, debtors and bills receivable. Inventory of raw materials, stores, space, etc. Then prepaid expenses, accrued income earned but not received. Then current liabilities include creditors, outstanding expenses, bills payable, accrued or expenses or outstanding expenses, short term borrowings, advances received, taxes, dividend payable, etc. These are the short term liabilities of the organization. So these are the components of working capital, that is current asset and current liabilities. So the type of working capital, here you can expect an essay question or paragraph question in your examination. So working capital can be broadly classified based on the concept and based on time. Based on concept, already we discussed the gross working capital and net working capital. Gross working capital means investment in current asset, and the net working capital means current asset minus current liabilities. Then here based on time, we can classify the working capital into fixed or permanent working capital and temporary working capital. Fixed or permanent working capital can be further divided into initial working capital, regular working capital, or reserve working capital. As the name indicates, initial working capital is the working capital needed in the initial, at the beginning of the operation, and regular means the fixed amount of working capital, regular payment of rent, regular payment of electricity bill, etc., wages, etc. So reserve means the amount needed at the contingencies or emergency time. The temporary working capital is a seasonal or special working capital. Seasonal, when the that means when the season arises, the production may be high. In that time, raw material should be purchased more. In that time, the need for working capital will be more. So these are the major types of working capital. You may expect an essay question from this area. Then working capital financing mix. So we have two sources of financing working capital. One is long term and short term. So long term sources as the our equity share, etc., equity preference shares. Then let's see which are the long term sources. Issue of equity shares, issue of preference shares, then debentures. These are the major long term sources. So retained earnings of the company, that is a part of the profit. Loans from the long term loans from the financial institutions, etc., the major long term sources. In the case of short term sources, we have internal and external sources. Internal means the depreciation fund that is kept apart from the organization. Then provision for taxation may be, time lag is the meaning. Then outstanding expenses. So the short term external source. External sources include trade credit, commercial papers, advance from customers, bank credit, bill discounting, bills acceptance, letter of credit, bank guarantee, etc. So the management of cash is another concept related to the working capital. So cash management is deals the cash management of inflow and outflow to the organization. So cash flows within the firm is the cash management. So managing cash flows means successful management inflow and outflow, or managing successful inflow and outflow of the organization's fund. Okay, so if cash collections are accelerated and cash disbursements also, as far as the possible, are delayed, that is better. So payment should be maybe delayed, and the collection will be accelerated, so it will be better to the organization. So management of receivable, here the concept should be understood in mind. So receivables management, receivables include the debtors and bills receivable, debtors and bills receivable. So the receivables creates from the result of credit sales. So we have, this is the short term assets. So receivable management is a process of making decision relating to the investment trade debtors, so which are the factors influencing the size of receivable? So size of credit sales, if we are ready to offer a lot of credit sales without any limit, that will influence the size. The credit policies of the organization, terms of trade, period of trade, expansion plan of the organization, relation with the profit, credit collection efforts implemented by the organization, habits of customers, whether customers are have an habit of payment due on due time or making delays. So these factors will influence the size of the receivable. That means if the customers have timely payment habit, the size of the receivable will be reduced. We will be able to get the payment on time. So we have no problem with the relating to the management of receivables. Another major important thing is management of inventories. So inventory means, it is the derived from the French word inventaire and the Latin word inventarium. Both means a list of things found. So in the case of organization, excessive stock can place a heavy burden to on the cash resources of the business. Excessive stock is not good. Also insufficient stock also result a loss in sales also. Insufficient result mean we can't produce. So inventory management, better management of the inventory, raw materials, work in progress and finished goods is necessary to the organization. So the meaning and nature of inventory means it is the raw material, it is a work in progress, it is a consumable stores, finished goods and spares. These all are come under the term inventory. Inventory management can be defined as the overall way a company manages inventory and uses its control system to manage the benefits of carrying inventory against the cost. So simple definition, there will be a question in your examination, a short answer question like define inventory, define management, cash management, define account receivable. So you have to put in shorter term the definition like this. So objects of inventory management, why we are managing inventory? We have two major objects, that is a financial and operational objects. So in the case of operational objects means that material and spares should be available to sufficient quantity at the right time, so that work is not disrupted. That is operational. But in the case of financial definition, financial object is investment in inventory should not remain idle. A lot of investment in inventory or raw material should not remain idle. That will, if it is remain idle without using, if it is bundling in our stores, it will lose the financial level. So these are the two things. Operational means the raw materials or the things, raw material or the inventory should be available in the sufficient quantity at the needed time, but it should not be remain idle. These are the two objectives, operational, financial objectives of the inventory management. Which are the tools or techniques of inventory management? So determination of stock level, we have a lot of stock levels, we will discuss in later. Determination of safety stock, selecting a proper system for ordering of inventory, or economic order quantity method, may use ABC analysis, use VED analysis, inventory turnover ratio, then aging schedule of inventory. These are the major techniques that can be used for the management of inventory. Our syllabus covers major area of stock levels. So some problems, simple problems may expect from stock levels or economic order quantity. So classification and codification of inventories also. So stock level Stock level, we have reorder level, maximum level, minimum level, safety, danger level, then average levels. So here you may expect a question for problem from this area. So you have to find out the reorder level with the equation. It can be calculated by maximum consumption into maximum reorder period. Maximum consumption into maximum reorder period, or minimum level plus average consumption into average reorder period. So another term is maximum level. Maximum level is the level where the reorder level plus reorder quantity minus minimum consumption into minimum reorder period. Minimum consumption into minimum reorder period minus what? Reorder period level plus reorder quantity. Then next is major items. So reorder level, minimum level, maximum level, minimum level. These are the three major items you have to kept in mind and understand. Minimum level. Minimum level means reorder level minus normal consumption into normal reorder period. So how to find out normal reorder period? Normal reorder period means average reorder period. So average reorder period can be calculated by using the formula maximum reorder period plus minimum reorder period by 2. Maximum reorder period plus minimum reorder by 2 is the average reorder period or normal reorder period. Then another thing is average stock level can be calculated. So major area is these three. Then reorder, maximum, minimum. Then average stock level, minimum stock level plus half of reorder quantity is the average stock level. So another thing is, so you have to expect from the stock level questions from the stock level, especially problem questions. You have to work out that. Another thing is economic order quantity, EOQ. EOQ means the ordering quantity problems are solved by the determining EOQ or the economic lot size, that is the optimum level of inventory. EOQ means optimum level of inventory. So you have to consider two type of cost in relating to the EOQ, that is ordering cost will be there and carrying cost. You can find out this EOQ by using a formula. So EOQ level of inventory which minimizes the total of ordering and carrying cost. So it is a level, that level minimizes the total of ordering and carrying cost. Let's see the EOQ formula. See the formula, root of 2AO by I. This formula can be in your some of the books given 2CO by I may be there, both are same. Let's see what are the things and we will solve a question based on this. So here A or C. A, sometimes in your book it may be shown as C, means consumption or annual usage or demand of the material. Ordering cost per unit. Then O. I is the inventory carrying cost, she is shown as a percentage of thing. Then total cost of ordering, TC. So this is your formula. You can, so let us see a question. EOQ, this kind of question is very important in your examination, so please work out some questions. So calculate EOQ from the following information: annual consumption 10,000, cost of placing an order 50, cost per kg of material 2, then 8% average inventory storage cost. So how to solve this question? So you can use the formula EOQ is equal to 2CO. C means A, both are same, by I. Here consumption, annual consumption is given in our question 10,000. Then order O is given as 50, cost of placing an order, ordering cost 50. 2CO, so 2 into 10,000 into 50. Then I means here you have learned that inventory carrying cost as a percentage. So I means 2 cost of per material is 2, then storage cost is 8%. So you will get 0.16, 8% of 2, that is 0.16. So while calculating this by using this formula, you will get an answer as 2500 kg. So this is the economic order quantity. Economic order quantity in this level is 2500 kg is the EOQ. Okay. Then another major term relating to our syllabus is inventory turnover ratio. You can find out the inventory turnover ratio. So it is this to indicate whether the inventories have been used efficiently or not. Inventory turnover, how many time it take to turn over to the in a year. So in a 365 days. Anyway, so it is also known as stock velocity. In your objective type examination, you can expect such a thing. Inventory turnover ratio is also called stock velocity. So it can be calculated as cost of goods sold divided by average inventory. Cost of goods sold divided by average inventory. So inventory conversion period. Sometimes your question will be like this, which is the inventory conversion period. So days in a year, usually 365 divided by inventory turnover ratio, you can be calculated by using this formula. So 365 or 360 divided by the ratio, you will get inventory conversion period. So this kind of question also you have to expect from this area. So another thing is, which are the major committees associated with the working capital in India. So we have a lot of committees relating to this. Major committees recommended relating to the working capital management and inventory management. The terms used are Dehijia Committee, Tandem Committee, Core Committee, Marathe Committee, Chakravarti Committee, and Kannan Committee report. These are the major committees. They have submitted financial and working capital management relating to the companies. So these are the major areas you have to cover under your third chapter, working capital management. Simply it can be concluded as working capital management, then cash management, receivables management, and inventory management. You have to expect problems from inventory management, then theoretical concept from working capital management also. Okay, these two are also important, but give more importance to working capital management, inventory management. Thank you for watching. Thank you all. Hello, once again welcome to all to the online classes organized by the School of Distance Education, University of Calicut. We are discussing the fourth module of financial management. The syllabus under this area, this module is capital structure theories. Capital structure theories. We have a lot of theories to be discussed. Then another concept is cost of capital and the leverages. Let's see what is capital structure theories and which are the major theories. So capital structure means the mix or proportion of firms' permanent long-term financing represented both by the debt, preference stock, and common stock of equity. So capital structure means is a mix of these three elements or three capital sources, that is debt, preference shares, and common stock. We have a lot of theories related to the capital structure, related to the net income theories, traditional theories, net operating theory, Modigliani and Miller theories. So the first theory relating to the capital structure theories. Before that, keep in mind these theories are the opinion about the capital structure of organization. So as per the net income theory or NI approach, the theory says that there is a definite relationship between capital structure and value of the firm. So here the two concepts are capital structure and value of the firm are related. That is the core area of this topic, this theory. So under this theory, capital structure of a firm influences its cost of capital and that directly affect the value of the firm. So the core area of this capital structure theory and net income approach theory, NI theory, is capital structure influences the cost of capital and also the value of the firm. That is a key area, a key thing in this theory. So we have some assumptions. Net income approach assumes that there is a continuous increase in debt does not affect the risk perception of the investors. Cost of debt is less than cost of equity. Then corporate income tax does not exist. So these are three major assumptions of the cost of net income approach. So this is the key area. So simply, net income theory suggests maximum possible debt financing. Maximum possible debt financing should be used in the organization, in the capital mixing or capital structure of the organization. Another is net operating income approach. Net operating income approach, NOI approach. This says that the theory of capital structure, which is weighted average cost of capital and total value of the firm, remain constant as financial leverage is changed. That means there is no optimal capital structure. Every capital structure is optimal, and the overall cost of capital remains constant for all degrees of debt equity mix. This is the key word. Overall cost of capital remains constant for all degrees of debt equity mix is the key area under this net operating income approach. And David Duran is the person who has advocated this theory. The net operating income approach is the exact opposite of net income approach. That means value of the net income approach is the value of the if capital structure mixing is affected or cost of capital is affected. Here net operating income says that there is no relation or it does not affect, that means it remains constant. Then as per NOI approach, value of firm is not dependent upon its capital structure. Net income approach says that value of the firm is dependent. Value of the firm is dependent of cost of capital structure. But here NOI approach, net operating income approach, says that it has no relation. It is not dependent. Here we have some assumptions. So students, I request you to learn the assumptions and the core simple meaning of these laws or these theories. So here Durant explains that weighted average cost of capital. Weighted average cost of capital is always constant and it depends on the business risk. Then value of the firm is calculated using the overall cost of capital, that is a weighted average cost only. Then cost of debt is constant. Then corporate income tax does not exist. Then another third approach is traditional approach. Soloman, Ezra advocate this kind of theory. Traditional approach. Third approach. This says that this is a theory of capital structure in which there exists an optimal capital structure. So there is a one word question here. Optimal capital structure is advocated in traditional approach by Soloman, Ezra. So optimal capital structure. So here optimal capital structure means the capital structure that minimizes firm's cost. Minimizes firm's cost of capital and thereby maximize the value of them. So optimal capital structure is a capital structure where the cost is minimized and value is maximized. This is the optimal capital structure explained by Soloman, Ezra under traditional approach of capital theories. Then our fourth approach is total value principles or Modigliani and Miller approach. Modigliani and Miller approach is similar to net operating income approach. So what net operating income approach says that there is no relation of value of the firm and cost of capital. So it provides behavioral justification for the constant, that means cost of capital, over the entire range of financial leverage possibilities. Here he says that overall cost of capital remains constant for all degrees of debt equity mix. The same in the case of net operating income approach. So this theory is explained by Modigliani and Miller. Then capital market are perfect and investors are free to buy. Some assumptions or buy and sell and switch between securities. Securities are infinitely divisible. Then investors can borrow without restrictions at par with the firms. So investors are rational and informed of risk return of all securities. These are the key things you have to keep in mind related to the capital theory. Then it has some proportion or assumption. Value of the firm is independent. This is the crux, independent of the capital structure, same like the NOI approach. But net income approach says that it is dependent. In the case of traditional approach, they says that there is an optimal capital structure should be followed. Optimal capital structure means value of the firm should be maximized where cost will be minimized. Okay, let's see which are the model's propositions. Next is value of the firm equal to the capitalized value of operating income, that is EBIT. Value of the firm equal to market value of the equity plus market value of debt. These are the major theories. So we have gone through the 4 theories: net income approach, net operating income approach, Modigliani and Miller approach, and traditional approach. Students are requested to have an idea about this thing and basic assumptions and key meaning of this term. Second topic under this module is cost of capital. Cost of capital means cost of capital, also called cut-off rate, or the target rate or hurdle rate or required rate of return for the investment. So Soloman Ezra defines the cost of capital as the minimum required rate of earnings. This is the meaning. Cost doesn't mean cost, but it is a minimum rate of return for the shareholders or the investment of the capital. Then what are the importance of cost of capital? It is an acceptance criterion in capital budgeting. Designing the optimal capital structure, cost of capital should be identified or analyzed. It is a basis for evaluating the financial performance of the organization. It's a basis for taking other financial decisions, dividend policies like risk issue, working capital issue. We have to, cost of capital should be analyzed. Then what are the methods to compute cost of capital? So cost of capital can be measuring the specific cost and measurement of the overall cost. Specific cost means cost of debt should be calculated, cost of preference share should be calculated, then cost of equity should be calculated. Then overall means all together of these elements. Then measurement of cost of capital. So cost of capital represents, already I have told you, it is the specific cost or expected return on the investment. Cost of capital may be from the debt, share capital, preference share capital, and equity share capital, retained earnings of the organization. Cost of debt. So it is a required rate of return for the creditors. Creditors mean those who have purchased the debt, debenture holders. So debt may be issued at par, premium, or discount, etc. So redeemable debt will be there, irredeemable debt will be there, convertible, non-convertible, a lot of type we have learned already. Cost of irredeemable debtors or perpetual debt. So this can be calculated by using the formula cost of debt equal to 1 by NP. NP means net proceeds of debt. Then cost of debt after tax may be calculated as KDA, means cost of debt after tax. Cost of debt into 1 minus T. 1 minus T means tax rate after tax. Then cost of redeemable debt. The principal has to be redeemed after the specific period, that is cost of redeemable debt. So here the formula to calculate the cost of redeemable debt is equal to 1 plus, there is an interpolation formula also, 1 plus 1 by N into RV minus NP divided by half of RV plus NP. So after tax formula can be it can be calculated based on the 1 into 1 minus t plus 1 by n into RV minus NP divided by half of RV plus NP. So RV means redeemable value, NP means net proceeds of debt, N means number of years of maturity because it is redeemable after a period. Then preference stock. Preference stock can be calculated as cost of preference D by NP divided by net proceeds. Then cost of equity also can be calculated by some approaches, dividend price approach, then dividend price plus growth approach, or dividend price dividend growth approach. We have to consider growth rate also. Then earning price approach, then realized yield approach. Let's see the items. Dividend price approach we can calculate by using dividend by NP or MP. So here cost of equity KE, D means dividend per share, NP net proceeds of an equity or market price per share. So you have to follow some questions from this area. Dividend price plus growth approach. So the cost of equity is calculated on the basis of the expected dividend rate per share plus a growth. So that is dividend price plus a growth. So in our formula you can see that there is a plus growth approach. Okay. Then earning yield method can be formulated by earning per share. Earning per share. So earning per share divided by NP or MP. So realized value, it is a limit one. So cost of retained earning. Cost of retained earning can be calculated by KR equal to KE into 1 minus T into 1 minus B. Another topic relating to the leverage analysis. Leverage analysis. So we have to analyze or go through the term what is leverage. So leverage means an increased means of accomplishing some purpose. So in the financial management, leverage means the firm's ability to use fixed cost assets or funds to increase the return on its owners. So this is the term or the meaning of the term leverage. Financial management, we can say that it is the firm's ability to use fixed cost assets with the equity shares. See, we have three kinds of leverage: financial leverage, operating leverage, and composite leverages. So financial leverage means the use of long-term interest bearing debt and preference share capital along with the equity. So this is the leverage or financial leverage, or that is also called trading on equity. So the practice of use of long-term interest bearing debt and preference share capital along with equity share capital is called financial leverage or trading on equity. The second concept is operating leverage. So operating leverage results from the presence of fixed cost. So here the fixed cost that helps to magnify net operating income fluctuations flowing from the small variations of the revenue. So the degree of operating leverage can be calculated here. So operating leverage is the using fixed operating cost or small change in sales revenue magnifies into larger change in operating. This is a condition of operating leverage. So here the multiplier effect is called the degree of operating leverage. These are the objective questions may be asked. Multiplier effect of the operating leverage is called degree of operating leverage. In the case of financial leverage also, we can say that multiplier effect of financial leverage is called a degree of financial leverage. It can be calculated as percentage change in EBIT, earning before interest and tax, divided by percentage change in sales. So degree of operating leverage means contribution divided by earning before interest and tax. The third term is combined degree of combined leverage. Combined leverage means degree of operating leverage into degree of financial leverage. We can see the notes. Combined leverage means using operating leverage and financial leverage together. A small change in sales magnifies into larger changes in earning per share. That is, the multiple effect of degree of combined leverage is multiple effect is called degree of combined leverage. So the formula is degree of combined leverage is equal to degree of operating leverage into degree of financial leverage. So these are the short note about the topic for our fourth module. So I request you to follow some problems also from this area. Some paragraph questions may be asked from this area too. So thank you for watching once again. Thank you all. Hello friends, once again welcome back to the online classes of School of Distance Education, Calicut University. In this session we are discussing the core paper Financial Management, its fifth module, Dividend Decision. Your syllabus covers dividend decision, type of dividend and major dividend models. So let's see the term dividend. Dividend is the amount or part of the profit of a company which is distributed by the company among its shareholders. So it is a part of the profit that should be distributed among the shareholders of the company. The dividend policy of the firm affects both the long-term financing and wealth of the shareholders of the organization. If we are providing dividend or distributing the dividend, that will affect the long-term financing capacity of the organization and also wealth of the company. So you have discussed a term dividend decision and value of the firm. The debate or argument is related to the these two terms is explained. That is, the value of the firm can be maximized if the shareholders' wealth is maximized. So we have two conflicting views regarding the impact of dividend decision on the value of the firm. Some school of thought argues that the dividend decision does not affect the shareholders' wealth, and some others argues that dividend decision affects the shareholders' wealth and also value of the firm. So the discussion is between dividend decision and the value of the firm. Some says that value of the firm and dividend decision affect the value of the firm. Others says that dividend decision does not affect the value of the firm. Let's see. So based on these two views, we have two school of thought relating to the dividend or the models of dividends. So one says that dividend is relevant. That concept is called relevance theory or theory of relevance. And others says that dividend decision does not affect the value of the firm, so that it is an irrelevance concept or the theory of irrelevance. So we have to discuss these two terms, theory of relevance and theory of irrelevance. So one of the most important model is Walter's model. Professor Walter, he supports the value of the firm and the dividend decision is have direct affection that directly affected. That is, relevant dividend decision and value of the firm is relevant. He advocates the relevant concept. So dividend decision is relevant in relating to the value of the firm. So Walter's model is based on the relationship between the firm's return on investment, that is R, return on investment is indicated as R, and the cost of capital, that is K. So according to Professor Walter, if R, return on investment, is more than K or cost of capital, if the firm earns a high rate of return on its investment than the required rate of return, the firm should retain its earnings. Such firms are termed as the growth firm. So the optimum payout will be 0 under this condition in the case of growth firm. And he again classified in the case of declining firm. Walter has explained three type of firms: growth firm, declining firm and normal firm. In the case of declining firm, which do not have profitable investment, that is R, rate of return is less than cost of capital. So the shareholders would stand to gain if the firm distribute its earnings. Here the optimum payout ratio should be 100%. That means the firm should distribute the entire earnings of as dividend under this condition, under the declining condition. In the case of normal firm, this is his third classification. Normal firm means the situation where the R is equal to K. So the dividend policy will not affect the market value of the shares under normal condition. So here Walter says that there is no optimum dividend policy. Second model is Gordon's model relating to the dividend. Gordon also advocate of relevance concept. Myron Golden has also developed a model on the lines of Professor Walter, and the dividend are relevant. He says that relevant concept, theory of relevance. So major advocates of theory of relevance are Gordon and Walter. That means he says that the dividend decision affect the value of the firm. So his basic assumptions are the firm is an all equity firm. That means no external financing is there. Then the rate of return of the firm's investment, that means R, is constant. Then the ratio of B once decided upon, retention ratio once decided upon must be it should be constant. That's the growth rate of the firm G also be constant. The cost of capital of the firm remains constant. The firm has perpetual life, that is long life. Then corporate tax does not exist. These are the basic assumptions. Based on this assumption, Gordon explains his theory. And according to Gordon, market value of the shares equal to the present value of the future stream of dividend. So Gordon's basic formula or valuation formula is you can see this P equal to E into 1 minus B divided by KE minus BR. So this is the theory explained by Gordon. Then next is Modigliani and Miller approach or model. Is the advocate of irrelevant model. What he is saying is, he is the advocate or thought, his thought is related to the irrelevance of the dividend. That means dividend decision does not affect the value of the firm. That is his concept. Then according to him, the dividend policy does not affect the value of the firm and therefore no consequence of dividend policy. Okay. Next, another model is residual model. Residual model also advocates the irrelevance concept of dividend policy like model. This dividend decision has no effect on the wealth of the shareholders or the price of the shares is the main thing or main concept under this theory. So we can conclude that Gordon and Walter advocates the relevance concept and residual theory and theory are irrelevance concept. So under the residual theory, the dividend depends upon the amount of earnings and the firm's profitable investment opportunities. That means if firm has profitable investment opportunities, firm has to invest their money in the profitable investment projects than distributing the dividend. This is the residual concept. So these are the major four types of dividend theories: relevance and irrelevance. Then we have a lot of type of dividends. Dividend may be different classes, different type or category. So the major are one is the cash dividend. That means if the enterprise is ready to pay dividend in the form of cash, that is called cash dividend. Then cash dividend may be in the form of regularly they may pay that, or interim dividend may be there. Then stock dividend. Here the dividend will be distributed in the form of shares to the employees, to the owners of the organization. Another method is scrip dividend. Here the company issues the dividend in the form of a promissory note. And another mode is bond dividend. Bond dividend means dividend paid in the form of debentures or bonds. Then property dividend means, as the name indicates, the property dividend of the company pays dividend in the form of assets other than cash. So these are the major dividend forms or types of dividend. So in this chapter we have two terms to be kept in mind, that is the relevance and irrelevance concept of dividend policy and also type of dividend. So the relevance and irrelevance concept may be asked as an essay question, and the types may be expected as a paragraph question. So thank you for watching and listening. Thank you all.